Hello, investors and traders, and welcome to the weekly market report. I'm AJ Monty, and this is a one-year daily candle chart of the iShares Russell 2000 ETF, ticker symbol IWM. I've left my lines on the chart from last week so you can see what the forecast looks like. And last week, right here, I extended my timeline. This was a diagonal line for the target that was placed the week before last. And I said I was leaving everything in place as is, as my target continues to be this gap fill down at this level. Now, all I'm going to do right here is more or less extend that out until it fills. Now, why am I saying it that way? Well, I know that the chart haters out there are going to try to hang me for this, but I continue to keep my downside target in place for that gap fill for many reasons. We're hitting resistance again. The oscillators are trending lower again. We have a negative divergence on the CCI. Again, I'm going to repeat this because this is very important that you understand how this works. When you have a higher high on price, but we have lower highs on the CCI, that's known as a negative divergence. And when Don Lambert created that tool, he pointed that out as one of the most valuable parts of the indicator, is that when you see negative divergences like that, it gives us warning that the momentum is changing. So that is definitely a negative. And if you look down here at the volume is once again decreasing on these last three candles that show higher highs and higher lows. Today, Friday, October 29th, as I record this, you'll see that we closed on the Russell with a spinning top. Spinning tops are usually found at pivot points. You see one right up here. You could see one down here. When pivot points form, that's usually when the short-term legs start to shift in momentum. It's a sign of indecision. It's very similar to how we read dojis. A doji more or less is a cross. You see one all the way back here. A doji and a cousin of the doji, which is a spinning top, they usually show up at these pivot points, or at least within close proximity of the exact high or exact low. Now, again, I'm keeping my downside target to this gap fill point, at which time we're going to have to see whether or not the market bounces at that level or fails to maintain that level as support, and then we'll have to readjust. Now, if you're a member of our option trading services, you'll know that this is a prime market for being able to collect time premium. We make our money by collecting those credits on the short side and letting time erosion work for us on those spreads. So whether the markets are going up, down, or sideways, the option traders who are spreading the market are going to do very well over time. And then once we break out below the 210 level, again, that's something I point out almost every other week at least, that's when we're going to shift our entire position to a negative delta position. So we're going to be getting out of every long position that we have on the spreads and going full-fledged into negative or bearish spreads. Now, if you are long the market, again, risk management is a key part of trading. If you are long and the markets are showing higher support along the way, then trail your stop. Because over time, when this market collapses, and I say when, not if, you want to be able to protect those profits and certainly prevent yourself from suffering a catastrophic loss. And so that is IWM. If I go right to the diamonds, which is ticker symbol DIA, you're going to see that we have not yet filled that gap, and we have not yet even reached that timeline, although the time is not as important as the price. That gap is still open, and we have two gaps below the market here, right there, and right here. And when those gaps fill, you generally get bounces. So if we come down and fill that first gap, we might see a little bit of a bounce. As we go back to fill the second gap, we might see another bounce. And then again, like IWM, we'll have to see whether or not that support level holds. Now, I'm going to pause real quickly to talk a little bit about Paul Tudor Jones. I traded with Paul Tudor Jones on the commodity trading floor. At the time, he was not as well known, obviously, as he is now. He traded a fund. He was a commodity trader. He's very much into the charts. And this came out last week on October 20th, and I'm going to put the link to this article down in the description box. It's very well worth your time to read this because he calls for, the Fed. He feels that the Fed is moving in the exact opposite direction than they should be. Historically, the Fed should be managing inflation, not creating it. And they're doing just the opposite, and they painted themselves in a corner. So pay very close attention to what's going on the global scale. And also, pay attention to the words that come out of Janet Yellen's mouth. Former Fed chair and Treasury Secretary is proposing some pretty outrageous things. I mean, we've outspent our capacity for collecting tax revenue. And so our government is running out of ideas for taxing the U.S. population. I mean, heck, we're now being taxed on the amount of miles we put on our car. Janet Yellen is talking about taxing you on money you haven't made yet and unrealized gains. I mean, it's getting out of control. And again, with the Dow, as I keep that gap target in place, you have to look at the overall Dow as far as historic levels. And if you go back 100 years, and I've shown this chart before, but I'm going to show it again with a little bit of a spin added to it. You see, this is where we are in vertical price action. And as I zoom in here, this vertical fan line or close to vertical fan line was broken last month. And I'll zoom in just one more notch because even though we had a higher high, we are still not back up over that former trend or fan line. And it's going to take a lot of work to get there. In fact, as we continue to bump our heads against that former trend line right there, and we start to pull back, that's what I often label as the KOD, the kiss of death. That's when the market fails to get back up on trend, and then the selling really starts to accelerate at those highs. Remember, this is a 100-year monthly chart of the Dow. And if you go back, it makes it look a little bit nicer when you go into a log scale chart. But I'm going to tell you right now, that doesn't change the bearishness of what we're seeing right here. Again, if you use a cycle finder on this one, I'm going to show you something that I did last night with our followers on a webinar that I did. If you go into the drawing tools here, if you're a Thinkorswim client, you can go and use the cycle brackets down here. And if I go and pick any low, I could pick the low here from 2003 or the low from 2008, but I'm going to pick this low right here and I'm just going to expand out. You'll see that what we have is a very rhythmic cycle in the market. Now again, this is going back some years, but if you look at the cycle lows, had you bought here, you would have made money. Had you bought here, you would have made money. Look, right at the bottom of the low right there, you would have picked the bottom, bought, and made money. Right towards the end of 2008, you might have been a little bit early on that bottom, but the cycle brought you to it. Right here, of course, because we're in a significant upward bull market at that particular point in time, you would have made money. But here's where I find it to be most interesting. This cycle found the exact bottom on March 2020, which again is when I did that open house Q&A session. I'll put another link to that in the description box so you can know the times when to buy and the times when not to buy, and especially the times when to sell or go short. That was a very well-defined low. And what does that mean for us now? Well, in between each cycle low, you generally find highs. You see this? It's not always the exact middle of that cycle, but you generally find them somewhere between the cycle lows, obviously. Right now, we're approaching the midpoint of these two cycle lows. And if I draw this out, you have to put a big question mark down here. Will that be the low out there somewhere in 2025? Again, this is a monthly chart. We don't know. Again, don't shoot the weatherman for forecasting the weather and the eye of the hurricane doesn't hit exactly where you think it's going to hit or where I think it's going to hit. I'm telling you right now, the tide is shifting here. And you have to keep an eye on what's happening in Washington because we are totally outspending ourselves when we compare to the economic growth. In other words, we're spending more money than the economy is growing. And ultimately, that's going to break. It's going to collapse. And that's where my role comes in to help people manage risk. So again, don't shoot the messenger. Look at the charts, prepare, and you have to use risk management strategies, whether you're trading or whether you are investing. So that is the diamonds. Let's go to the Qs, QQQ. This is a monthly chart as well. Look at that extreme vertical move on the fan line. As I zoom in here, you will see that we have a downside target way down below the market. Now, again, I'm holding that as a gap fill point. Why? Because this fan line right here, once this fan line is broken here, by this gap filling here, then we have that concept of the kiss of death. Fan line broken, attempt to get back on trend, and then the failure. Okay, so we're not months and months away from this potentially happening. We're talking about the possibility of this happening all by the end of the year, right? Again, if you are long, trail your stops. If you are short, then you put buy stops above the market. If you are spreading the market, then congratulations, you're collecting profits from time value and time decay. And again, keep your eye on the charts. So again, I'm keeping that in place. I'm just going to extend that out so we have that good timeline in place. I'm just keeping it just like that. And then we're going to see whether or not that gap fills. I think it will. And this brings me to the VIX. Because remember, I told everyone that there's a 100% chance the gaps on the VIX will fill. And I highlighted the 3 gaps here, here, and here. And I said for the first time in history, we had 3 open gaps above the market that were unfilled. Guess what? We've already filled this gap. We came very close today, actually, of filling this gap. I think this will ultimately fill. And then the top gap will fill, again, eventually, because history tells us since the VIX has been created, 100% of all gaps have filled. Why? Because it's an oscillating index. It's not a stock that trends. It's an oscillator. So keep an eye on that. You can see that there's a very definite pivot point here, and that's only going to add to the downside of the S&P over time. All right. Now, with that said, let's go right to the S&P. I am keeping that target, by the way, in place. I'm not moving it. Just like that, keeping that target from last week. All right, so SPY, we take a look at that. And now what do you have? Gaps below the market. Well, if the VIX had gaps above the market, then the gaps on the S&P are going to be below the market right here. We have 3 open gaps below the market. Now, the first line of support will be right here. Again, the gap fill rules are pretty simple. 80% of the time gaps fill. When they fill, there's an 80% chance that the price will bounce. Well, notice at this gap fill, the moving average will most likely start to move up to that level. So the moving average will act as a support level. Then, upon failure of that support level, eventually, you'll see another support level down here, which you'll see the same thing. Bounce and most likely a failure, ultimately filling the gap all the way to the downside. Hence the reason why I'm keeping that gap fill target in place right there. One other point about the SPY, look at the higher highs that we have here. Look at the lower highs that we have on the CCI. And notice 3 days ago, we crossed with a sell signal on the stochastics. Right? That's, again, oscillators are crossing and showing negativity to the downside. We have higher highs, but lower highs on the CCI. Again, that negative divergence, and that's something you have to pay very close attention to. So again, SPY or any S&P stocks that you have profits in, protect those profits with sell stops below support levels, and then move on to your next trade as you see support and resistance levels start to surface. Now, I'm going to do something a little bit different in light of the Bitcoin and cryptocurrency traders. I'm going to go to the New York Bitcoin Index, where I'm showing this as a weekly chart. Now, notice what's happening here in Bitcoin. Last week, because this is a weekly chart, last week we had a shooting star. That's the second most bearish candle, tied with another second most bearish candle, which is a hanging man. So we have 2 back-to-back in number 2 position, bearish candles, and the oscillators are turning lower. We have a hinge on the CCI, not quite at a sell signal just yet, but soon to be a sell signal once that line crosses below the plus 100 level. So in addition to that, we have a wide divergence from this moving average, close to a resistance level up here. So again, If you're in Bitcoin or any of the crypto markets, you again want to watch and protect your profits. And then once the market pulls back to that moving average or another key support level, and you see a pivot point with oscillators starting to pivot up, that might be another time to get back in at the lower levels. Again, I'm putting the links to this reference of Paul Tudor Jones and the market report that I put out in March of 2020, so you have a reference for how to read the signals when the buy signals show up. You have a great weekend. Thank you so much, and I appreciate your following and sharing and liking this video. Again, thank you. Bye-bye.